Hi, my name is Jim Brees from GreenGrowth CPAs, and today I want to talk to you about how to reduce your tax liability as a cannabis company. Now, Tax Code 280E puts a very heavy burden on cannabis operators, and if you don't know what that is, let me go over real quick. So Tax Code 280E says that anyone that has a Schedule 1 controlled substance in their business or uses that or trades that can only deduct COGS to create a tax base and then finally are taxed on that gross margin. Now, COGS are a very specific expense in your business, but there are creative ways to reallocate other indirect costs into COGS, which will help greatly reduce your margins and your tax liability. So let's hop right into the computer and I'll show you and walk you through step by step how we do this for you as a cannabis operator through our outsourced CFO service.
All right, so we're going to discuss how to reduce your taxes with 471 allocations. Again, my name is Jim Brees from GreenGrowth CPAs. But before I discuss this, I need to let you know that the information contained in this video is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's hop right into 471 allocations. So 471 is a tax code that defines inventory capitalization rules for businesses. And this section of the law defines what you can put into the inventory costs. And if something counts as inventory, then it can be considered COGS. This will drive down your gross margin and ultimately reduce the taxes that you have to pay out. But how do you know what can actually be reallocated as inventory and thus COGS? Well, there are certain methodologies accepted by the IRS that operators must use to assign costs under COGS. And if you just assign costs randomly, you will be penalized and surely you will be audited. So how does the 471 allocation process actually work? So when you outsource your CFO service to GreenGrowth CPAs, we will walk you through an initial setup and an analysis of your actual or projected financials depending on the state of your business and where you're at. From there, we will be able to provide you with an ongoing allocation of costs on a monthly basis to prepare for cash and tax planning. There are three main benefits to this type of analysis. You'll receive a budget or a financial model, you'll understand some strategies to save money and allocate the appropriate costs, and a projected tax liability estimate. So let's look at each benefit individually. First, you will get a robust financial model for budget planning. This model can be easily manipulated and customized for your business depending on many different input variables. And this budget can help improve the accuracy of your business in tax planning. I know it's something that we all have a headache when we walk through that type of process, and this model helps alleviate some of that stress and unknown. And the financial model also gives you the ability to run a sensitivity analysis to see what happens if, you were to change a few inputs to your business model. What do the final pro formas and financials look like for your business? The second benefit of this allocation analysis is that you'll understand specific strategies to save money and allocate costs. We're going to give you a projected analysis of how much of each cost that you're able to allocate to COGS, thereby driving how much you can save in taxes. This leads me to my third benefit, which is to have a projected tax liability. It's best to learn ahead of time how much money you'll be likely responsible for paying in taxes instead of just getting a random bill every quarter. This understanding helps you plan how much of your fund flow you need to put aside each month, and trust me, it's incredibly tough to come up with $350,000 in 2 weeks in April if you haven't been planning for it. So we help you plan and budget for your taxes accordingly. Now, allocations under the 471 apply differently for cannabis resellers and cannabis processors. So as a reseller, you have direct costs like product and your material costs, and indirect costs including things like rent, utilities, payroll, licensing, insurance, things like that. And keep in mind that if you're a reseller of other brands' cannabis products, then you don't get to capitalize your indirect costs, only the direct costs. And as a reseller, unfortunately, you'll have the largest tax burden of anyone in the cannabis industry because your taxable base is that much higher because you cannot capitalize those indirect costs. And this is one of the biggest takeaways we learned from the Harborside versus the IRS case. And the federal government is not shy about penalizing cannabis resellers. But cannabis processors, on the other hand, are allowed to take indirect costs and allocate a portion to COGS, taking a reduction in taxes as a result. So this puts processors in a much more powerful tax position. So if you're in a position to do cannabis extraction, make edibles, or perform other light manufacturing, this can qualify your business as a processor. And when you hear processor, you may think big machines and a huge operation, but you don't need to be a large-scale manufacturer to be considered a processor. Now, in our experience, we have seen some businesses do something called value-added processing. In this scenario, a processor gets one cannabis product, adds something to it, and then repackages it. This is still considered manufacturing and can help you gain that better tax position that we're talking about earlier in this video. So you might be asking, how do you qualify as a processor? Well, the first thing you need to do is check your license type and see if it allows for manufacturing. And if it does, great, you're all set. But if it doesn't, you need to see how much a license costs for manufacturing in your jurisdiction, even if it's possible in your jurisdiction, and if it's in your best financial interest to apply for one if it's available. You should consider and factor in the potential tax reduction that you will have over the long run when qualifying as a processor in your financial calculation. Your decision will vary based on the state in which you operate in. For example, in Oklahoma, it's very cheap to apply for a manufacturing license, so why not apply for one, right? Now, if you are at the point where yes, you can do manufacturing, the second thing you need to look at is your capabilities and your space. So are you able to do something heavy or a light manufacturing? And if so, you could explore that route and that type of investment. But if you have limited space, like at a dispensary, then you have two potential options for your business. So option number one, you can buy bulk flower, which you probably already have, and make pre-rolls, which you probably already do, and then package them in your own branded packaging, which you also probably already do. So that's your first option for manufacturing. Or option number two, you can buy cartridges in bulk and remove them from the original packaging, then put them into your own branded packaging, and voila, you are now a processor. See, you don't really need a big investment to add processing to your cannabis business. You just need to be creative or just engage us as your CFO to find a way to make this work for you and your business. Finally, let's explore the impact of 471 allocations on your tax payment to know if it's really worthwhile to invest the time to apply for a new license and add another operational step to your cannabis business. Let's walk through a quick back of the envelope calculation to show the potential tax savings and the ROI you may expect from qualifying for the 471 allocations. Now, many cannabis dispensaries see a margin of around 50%, so that means that if your sales are $2 million, your margin is $1 million, and you pay tax on that margin. So with the new Tax Cuts and Jobs Act, the cap tax rates for C Corps are at 21%. That means at 21% tax, you'll be paying $210,000 in taxes without doing the 471 allocations. Now, if you allow us to help you with these 471 allocations, we could potentially add maybe $260,000 of additional allocations to your COGS, thus reducing your margin down to 37%, for example. That means that your new tax base is $740,000. And at a 21% tax rate, you would only pay about $155,000 in taxes. So if you take the difference of the $210,000 and the $155,000, that's about a $55,000 in tax savings every year. And with that kind of money, you can reinvest into your business, grow revenue, and improve your operations. Ultimately, this means that you can save more and more every year in taxes and deliver a great advantage for you against your local competition. So to summarize, the 471 allocations make it possible to expand the number of costs that you can legally claim under COGS. However, to take part, you must be considered a processor. So a cannabis business operator should seriously consider expanding their operation to qualify as a processor, as processors have more indirect costs which qualify as tax liabilities. And most importantly, these tax savings happen year after year, and you can reinvest in your business year after year. Now, hopefully this video has brought you some value and helped you understand and get some ideas on how to reduce your tax liability as a cannabis operator. Now, if you think it may be helpful to outsource your CFO duties, no matter what stage of your cannabis company, then you can get in touch with GreenGrowth CPAs by reaching out to us via our website at greengrowthcpas.com, or you can give us a call at 800-674-9050. Our tax and finance experts at GreenGrowth CPAs can help you by offering an analysis and full implementation of the 471 allocations through our outsourced CFO service. So thank you for watching. Hopefully this video was helpful, and have a great day, and we'll talk to you soon.